And the government is now admitting that the government-to-government oil deal with Saudi Arabia has failed. In communication with the International Monetary Fund, IMF, the government now says it will go back to the open tender system, OTS, for oil importation. This in contradiction to the robust defense of the G2 deal with senior government officials, saying it would be the solution to dollar shortages being experienced in the country, as well as the rapidly depreciating value of the Kenya shilling to the dollar. So, just what went wrong with the deal? Here is Jimmy Mbogo with the details.
In March 2023, the Kenya shilling was trading at 125 shillings against the US dollar and climbing, at the time, an unprecedented rate for the Kenya shilling. With this volatility, players in the FX market and investors adopted a wait-and-see approach, holding on to their dollars for a better rate. Businesses were struggling to get the hold of the dollar they needed to import their goods. The oil industry was said to be adding to this pressure with the need for dollars every month to import the fuel needed in the country. The government then announced that it was entering a government-to-government deal with Saudi Arabia that would see Kenya pay for oil in Kenya shillings and save up to $500 million every month in importation costs. With a bullish President Ruto saying that the deal would stabilize the shilling and make it gain against the dollar.
My economic advisor, David Ndi, Mohammed Hassan, Davis Chifchir, and the young man at EPRA, those four gentlemen have done something phenomenal in our country. They have managed to put together a program that has taken us away from looking for $500 million every month to buy our fuel needs, which was slowly snowballing into a crisis. Today, as a country, we can buy fuel in Kenya shillings. In fact, in my estimation, in the next couple of months, the exchange rate will come below 120 shillings. Maybe 115.
A promise that 9 months down the line has not been fulfilled, with the dollar-shilling exchange rate worsening even further to stand at over 160 shillings to the dollar, counter to the intended outcome of the G2G arrangement. In a startling admission, the National Treasury now says that the deal may have made things worse and that it intends to pull out of the deal. In a correspondence to the International Monetary Fund, IMF, the National Treasury says, and I quote, "We are cognizant of the distortion it has created in the FX market, the accompanying increase in rollover risk of private sector financing facilities supporting it, and remain committed to the private market solution in the energy market. We commit that all FX conversation done as part of oil scheme will be done at market rates." End of quote. But just how did the deal that was supposed to be the magical bullet for the Kenyan currency go so wrong? According to Kwame Owino from the Institute of Economic Affairs, though the deal was well-intentioned, the shilling was due for a correction.
The only reason the extension for another year was made was government of Kenya was supposed to guarantee volumes would increase, which is very curious because that would mean that somebody in government assumed or wished away the fact that, look, prices in real terms were rising on this other side based on taxes and all that. And if you raise the price of something, fundamentally you'd expect the volumes that are purchased to decrease. But if all these things were part of the understanding, then this agreement was in trouble very early, much earlier than we thought.
The about turn on the G2G oil deal now vindicates the opposition, which was the first to cast aspersions on the G2G deal, with the opposition chief Raila Odinga poking holes in the deal, saying it is a scam that would have driven up the cost of fuel to benefit a few government officials.
You find that you're being charged 217 shillings, but actual price will be 187 shillings. Now, where we are not sure is how that 30 shillings is being distributed, who is the beneficiary. So what is happening here is a complete rip-off. People are paying for air, and these people are very happy with this.
The government now will be forced to go back to the drawing board to find other ways to stabilize the Kenya shilling, which has lost nearly 30% of its value, trading at an all-time low of 161 shillings against the US dollar. Jimmy Mbogo, Citizen TV, Nairobi.